Your business made $100,000 last year. So why are you checking your bank account before buying groceries? You had customers, you had sales, you even made a profit. And somehow, you're still broke. That's not a sales problem. It's a cash flow problem. And it's one of the biggest reasons businesses that look successful on paper can quietly run out of money. Because here's the part nobody teaches you. Making money and having money are two completely different things. Today, I'm going to show you where the money disappears, why a profitable business can still run out of cash, and the simple system you can use to stay in control. Let's go back to that $100,000. Imagine you run a service business and generate $100,000 in sales over the year. Your dashboard looks beautiful. Revenue, $100,000. But revenue doesn't mean you have $100,000 sitting in your bank account. Let's say it costs you $60,000 to deliver those services: employees, software, transportation, equipment, marketing, rent, suppliers, and other operating costs. On paper, that leaves $40,000 before taxes and other costs. But imagine $20,000 of your customer invoices haven't been paid yet. You may have earned that money, but you don't have it available to spend. Your records can show money you're owed, but your bank account only cares about what has actually arrived. That's the difference between profit and cash. This is where many new business owners get confused. They look at sales, they look at profit, they see growth, but they don't look closely enough at when the money actually arrives. You need to understand three numbers: revenue, profit, and cash flow. Revenue is the money your business generates from selling products or services. Profit is what's left after your business expenses. But cash flow asks a different question. How much actual cash is coming into the business and how much is leaving? And timing matters. You could sign a $50,000 contract today, but if the customer says, "We'll pay you in 60 days, you don't have $50,000 today. You have a $50,000 payment coming later. Your landlord isn't accepting promises. Your employees aren't accepting promises. Your suppliers aren't accepting promises. Your business needs cash now." Here's a simple example. Imagine you own a construction company and land a $100,000 contract that will cost $50,000 to complete. You think, perfect, I'll spend $50,000 and collect $100,000. But the customer won't pay until the project is finished. So you start spending. Week 1, $10,000. Week 2, another $10,000. Week 3, another $15,000. Week 4, another $15,000. You've now spent $50,000, but the customer still hasn't paid. Then payroll is due. Your supplier sends another invoice. Rent is due. Something breaks. Your bank balance keeps getting smaller. The contract can be profitable. The customer can be real. The work can be real, but the cash isn't there yet. That's why a business can be profitable and still fail. Sometimes the business doesn't fail because it doesn't make enough money. Sometimes the money simply arrives too late. And this isn't just theoretical. QuickBooks' 2026 Small Business Late Payments Report found that 59% of surveyed small businesses had invoices overdue by 30 days or more, while businesses with unpaid invoices were owed an average of $17,700. Think about that. You can do the work, deliver the product, keep the customer happy, and still be waiting for your money while your own bills keep coming. Your customer may consider the transaction finished, but your business still has to survive the gap between the sale and the payment. Now here's something even more dangerous. Growth can actually make your cash flow problem worse. Everyone tells you, get more customers, increase sales, scale, but growth requires cash. Imagine your business normally generates $20,000 in sales each month. You decide to scale, you spend more on advertising, you hire people, you buy more inventory, you upgrade equipment. Your sales jump to $50,000 and everyone congratulates you. But your expenses have also increased and your customers are still taking 30 or 60 days to pay. You didn't just increase your revenue. You increase the amount of money you need before you collect that revenue. That's the growth trap. A business can grow faster than its cash. So stop asking only how much am I selling? Start asking how much cash do I need to support these sales? One of the simplest ways to improve cash flow is to get paid earlier. If you're a service business, you don't always have to wait until the end of a project to collect everything. You can structure the payment schedule around the work. For example, you could agree on a 40% deposit, 30% at a defined milestone, and the remaining 30% when the project is completed. On a $10,000 project, that means receiving $4,000 before you even begin. That money can help cover some of the costs required to deliver the work. The exact payment structure depends on your industry and contract, but the principle is simple. Don't build a business where you constantly pay everyone today while waiting for everyone else to pay you tomorrow. Your payment terms are part of your business model. Now let's build the system. You don't need complicated financial software to start. You need a simple 13-week cash flow forecast. Create 13 columns, one for each upcoming week. Start with your current cash balance. Then list every realistic source of cash you expect to receive: customer payments, deposits, subscriptions, sales, and anything else you can reasonably expect. That's your cash in. Then list everything you expect to pay: payroll, rent, suppliers, advertising, software, taxes, loan payments, and other expenses. That's your cash out. Then use one simple calculation: starting cash plus cash. In cash out equals ending cash. Take that ending cash number and make it the starting cash for the next week. Continue for 13 weeks. Now you can see problems before they happen. Maybe 3 weeks from now, your projected cash balance drops dangerously low. You don't wait until that week arrives. You have time to react. You can follow up on outstanding invoices, delay a non-essential purchase, reduce unnecessary spending, renegotiate a payment schedule, increase sales, or ask for deposits. The goal isn't to predict the future perfectly. The goal is to stop being surprised by it. A cash flow forecast doesn't create money. It gives you visibility, and visibility gives you time to make better decisions. And there's one more rule: stop operating with an empty tank. If your business has exactly enough money to survive until the next customer payment arrives, you're vulnerable. One late payment, one unexpected bill, one broken piece of equipment, or one slow month can put you into crisis. That's why a cash reserve matters. The exact amount depends on your business, but the principle is universal. Your business needs breathing room. Don't think of cash sitting in reserve as money you're failing to invest. Think of it as protection against bad timing. Sometimes a business doesn't fail because the opportunity was bad. It fails because the timing of the money was bad. And here's the habit I want you to build. Once a week, ask yourself 5 questions. How much cash do I have today? How much money am I realistically expecting to receive? Who owes me money? And when are they expected to pay? What bills are coming in the next 30 days? And where will my projected cash balance be 4, 8, and 13 weeks from now? That's it. You don't need to be a financial genius. You need to know what's happening with your money before it becomes an emergency. Because business isn't just about making sales. It's about managing the distance between earning the money and receiving the money. So let's go back to the question we started with. Your business made $100,000. Why are you still broke? Because revenue isn't cash. Profit isn't cash. And growth isn't automatically good if your cash can't support it. The businesses that survive aren't necessarily the ones with the biggest sales numbers. They're the ones that understand timing. They know what's coming in, they know what's going out, they know who owes them money, and they know how much cash they need to keep operating. So remember this: revenue tells you how much you sold. Profit tells you whether the business is economically viable. Cash flow tells you whether you can keep paying your bills while you build it. Don't just build a business that makes money. Build a business that knows where the money is, when it's coming, and how long it needs to survive until it arrives. If this video taught you something about business that nobody explained to you before, subscribe. And tell me in the comments, would you rather have $100,000 in sales or $50,000 sitting safely in your bank account? Because your answer might tell you more about business than you think.